Today we're talking mortgage insurance. Who's required to have it and how long are they required to have it for? Hey guys, Orbel here. The goal of today's episode is to better help you understand mortgage insurance. So first things first, let me read to you guys the definition for mortgage insurance. We have mortgage insurance protects the lender or the lien holder on a property in the event the borrower defaults on the loan. Now, there are three key factors that go into calculating mortgage insurance. You have credit score, you have debt to income ratio, and loan to value ratio. Anytime you put less than 20% down, you're going to be required to have mortgage insurance. But there's also three different types of mortgage insurances. So for the first one, it's conventional loan, right? So this is your regular monthly mortgage insurance. And whenever you surpass a certain amount of equity in the property, you could request for this mortgage insurance to be taken off. And we will dive into this a little bit later. The second one is for FHA loans. Now for FHA loans, it's interesting. You actually have two types of mortgage insurance. The first one is regular monthly mortgage insurance. The second one is upfront mortgage insurance premium. Now for this second one, it's similar to the first one, except it's a one-time fee, and it's just a percentage based off of your loan amount. And more often than not, it's built into the financing, so you don't have to worry about bringing it at closing to escrow in one lump sum. But the only thing to keep in mind with FHA loans is that this mortgage insurance never comes off of the loan. It's going to be on there for the life of the loan. So if you keep this mortgage for all 30 years or all 15 years or whatever your term is, you're going to have mortgage insurance throughout this whole time. Where the first one, the conventional mortgage, it does drop after a certain point. So you just have to keep that in mind. Third, we have the VA. So for VA loans, they actually don't refer to it as mortgage insurance. They call it a funding fee, and it is a one-time fee that you pay. And in very rare instances, they will waive this funding fee if you meet a very specific requirement that they have. And I believe it's just service-related disabilities, or if you've received the Purple Heart and a few things to that nature. If you meet those requirements, they will waive it. But more often than not, it's just a one-time fee that you do pay. Now, lastly, I want to mention a question that I get asked pretty often. And this question is, how can I get rid of my monthly mortgage insurance? So there's two ways to go about this, and both of these methods only apply to people who have a conventional loan. So option one is that you either pay down your balance long enough that your new loan to value ratio is 78%, or also 22% or more equity in the property. Now, technically, when you get to this threshold, the bank is supposed to just step in and drop that mortgage insurance for you. But I've heard from different people that in some cases, they give people the runaround, or they're not easy to work with. So you just have to make sure that you're persistent and that you're calling and following up so that they actually do drop this mortgage insurance. Now, the second method is a little bit different. The second method, you're assuming that the value of your property has increased from the time that you purchased it, and that with this new added equity, your new loan to value ratio has changed to 80% or 20% or more equity in the property. So if you believe that you have this new added value, what you're supposed to do is call the bank and ask for them to reevaluate the property. Now, more often than not, what they're going to do is they're going to require for you to pay for an appraisal. An appraiser will come out and do his or her job, and they're going to evaluate the property. If the value is actually there and you are correct, then they're going to go ahead and they're going to drop that mortgage insurance. So that's pretty much how it works. You have two options, and both options require that you gain equity in the property in order for them to go ahead and to drop this MI. So I hope you guys took away some good information from this video, and if you guys did, please share the channel and the videos with your friends and family. And thank you again for joining in. I'll see you guys next week.